Some New Jersey members. I'll start again. Good afternoon and welcome to our ISM New Jersey members, chapter partners, and guests. Today's session about economic climate, where we are now and what lies ahead. Really timely topic. We're very happy to have our guest speaker today here. So before that, let me just introduce myself very quickly. I'm your host, Preeti Kaur. I'm the president of ISM New Jersey and professionally global head of professional services sourcing at CSL Behring. Today, our guest is Tom Derry, and he's the CEO of ISM. Welcome, Tom. Tom has more than 30 years of experience in leadership and general management roles for public, private companies, as well as nonprofit sector. I don't know if I can sum up and give an introduction about Tom in few words, but I will say our esteemed guest is here, and everybody, I believe, should know you and knows you across at least our network. So without any further ado, Tom, I'm gonna pass it over to you, and please get us, shed some insight and share your thoughts, data, perspectives on what's happening in the world today.
I'm very happy to, Preeti. Thank you very much for that. I appreciated the shortened introduction. That's good. And by the way, it's getting closer to 40 years than 30 years now, so maybe a time for an update.
Definitely. Okay. Thank you. Thank you for that.
That's on me. So I'm going to attempt to share my screen now and just get right into it. And let's see. Here it is.
And as you're sharing your screen, I'll just let everybody know, please use the chat and Q&A function to send us your question. We want to keep it interactive. We have a Q&A planned at the end, but let's keep it interactive. So send us your thoughts and questions.
Yeah, I'll be, I don't know if I can keep an eye on the chat myself, but Preeti, if you flag any questions, I would welcome any interaction from anybody in the audience today, because maybe they want me to clarify a point I'm making, or, they have a question, or their own company's experience might be a little bit different from the general view that I'm presenting.
Yeah,
so I'm going to begin with the slide that I usually begin with, which is the correlation over 14 or 15 years now of the two PMI indices that we publish every month. The manufacturing PMI comes out on the first business day of the month, and the services sector PMI comes out on the third business day of the month. Hopefully you're all very familiar with these, although I'm going to spend a few minutes on them because I think they're underutilized, and there's a lot of richness to the data, and I think it offers practitioners in particular a great opportunity to recalibrate their supply strategies based on economic conditions and what's happening in the various markets. So as you can see here, the blue line is the change in US GDP on a quarter over quarter basis. And you can see how closely correlated that is to both the manufacturing PMI, which is the orange line, and the services PMI, which is the gray line. It's one of the reasons why the data is so closely followed by the federal government, by academics, by policymakers, and by business people, because we are the closest thing to a real-time leading economic indicator that exists in all of economics. We've been publishing the manufacturing data since the 1930s, so it's got quite a time series there. So we've got people who do mathematical modeling love it because they can run their models over a many decade period and test the regression and see how it works. One thing you should know is that the manufacturing component of the US economy is about 12% overall, and the services sector makes up the remaining 88% of the economy. That's important to remember because I'm going to show you a handy little calculation in a second. And you can see the far right-hand side of this chart, the very severe recession that we had in the spring of 2020, so March and April of 2020, followed by the very sharp rebound, right, beginning in May of 2020. And you can see they're almost mirror images of one another. We had an almost unprecedented economic contraction as we went into lockdown, not just in the US, but globally. And then we had almost unprecedented rebound from that as people began to realize that we can't just shut down the global economy. We have to continue to find a way to work together, whether it's virtually or however else we were going to do it. We weren't going to be traveling. We weren't going to go to restaurants. We weren't going to get a haircut. I wasn't getting my haircut anyway, so that wasn't a problem for me. But you can see how sharply we rebounded from that recession. I want to move on to the next slide. This is very similar chart. This is the uh, combination of the manufacturing and services PMI numbers. And I want to point out the three most recent recessions. You can see the recession of 2002 on the far left, the deep recession we had in 2008 and 2009 after the great financial crisis, and the very brief but very deep recession we had in the spring of 2020. If you look at the reports as they're published, they come out on the ISM website within a minute or so of the 10 a.m. release date, and they're free to everyone. So I encourage you, if not personally, maybe to get an analyst on your team to do this. Spend 15 or 30 minutes once a month with each of the reports. In the report we publish each month, what the headline composite index correlates to in terms of US GDP growth. So in this particular case, the current manufacturing PMI came in at 57.1, the services PMI a little bit higher at 58.3. Those are the data that was released earlier this month in April. And in that report, it tells you what that run rate of 57.1 and 58.3 equates to historically to US GDP growth. So you can take that and do a weighted calculation. So you have to know that 88 and 12 number, and you run 88%, weight the services number by 88%, weight the manufacturing number by 12, add those two scores, divide by 100, and you get the actual US GDP run rate at the moment. You can see here, as of the beginning of the month, it was at 2.99%, just obviously a hair under 3. That's a pretty good number historically. In the Obama administration, we would have loved to have seen, GDP growth rates approaching 3%. We weren't quite seeing that, but that's down pretty sharply from the fourth quarter of last year, where it was running at more than 7%. And earlier in the year, it was running in double digits. So what happened, we had an unprecedented sort of rebound, and we had very strong demand, especially for goods in the U.S. economy. I'm going to get into some of the reasons for that in a moment. We're about 21 months into a typical 35-month expansion cycle, so we should have room to run in the current economic expansion in the United States. There is some concern about maybe the back half of 2022 or early 2023 as interest rates rise. They could lead to some recessionary pressure in the overall economy. We're also concerned about inflation in the economy. I'm going to give you some data on that in a minute. So there's some definite headwinds in terms of U.S. economic growth that we're looking at either late this year or early next year. But I encourage you, when the Commerce Department releases the GDP number at any given quarter, it's for the prior quarter, and it's 3 months late, and then it gets revised 2 or 3 times after that. So it's very difficult to rely on official government statistics to understand how GDP is moving at any moment in time. Our data is collected in the last few days of the month and released on the first and third business day of the month. So it's, as I said, the closest thing we have to real-time data in all of economics, which is why it's so widely followed. Alan Greenspan, when he was chairman of the Fed, said, he was asked a question, if you could only have one economic indicator, what would it be? And he said the ISM PMI. So that got everyone's attention and really, put us on the map, I would say. And if you don't know this, we're very proud that every month we privately brief both the White House Council of Economic Advisors and the Federal Reserve Board of Governors on the data the day before its release. They need to be prepared to act. If the markets will move, they do move based on our data. And if the markets move dramatically in either direction, either up or down, the Fed needs to be prepared, and the White House needs to be prepared to maybe take action based on that. So we'll give them 24 hours heads up so they can be prepared to deal with a particularly strong or particularly weak number. Now, if you don't know, the index is a diffusion index. So what we're actually asking people is, for our list of questions, are conditions the same, better, or worse than the prior month? It's as simple as that. We calculate the number, all of the betters plus 1/2 of the sames, and that gives us a chance to calculate this diffusion index. It's a mathematical equation that measures the breadth and strength of a set of phenomena. So the higher the number above 50, the stronger the economic expansion, and the lower the number beneath 50, the stronger the economic contraction. And you can see we're a very good predictor of when we head into recessions, you can see from this chart. And even more importantly, we're a much better predictor of when we're coming out of recessions. So when we're in one, it's very important to watch the movement of the PMIs to indicate how close are we to getting back into growth mode again. So we also correlate very closely to inflationary pressure, or price pressure in the economy. As I mentioned, the services sector of the US economy accounts for 88% of all economic activity. So that's why we use the services CPI number as a proxy for inflationary pressure across the entire US economy. You can see that over time, changes in the CPI correlate very tightly with changes in the prices index that we report in the services monthly report. And you can see on the far right-hand side of the chart, after the recession again in the spring of 2020, we've been experiencing very high price increases as reported in the services report, followed by very strong growth, which is seen on the left-hand index in this chart of the CPI number. Most recently was at 8.5%. So we're dealing with broad-based inflationary pressure. And I'm going to talk about a couple of factors that contribute to inflation. So I'll just go right into that right away. This slide is from the Bureau of Labor Statistics, and I think it's very illustrative. This is the change in the producer price index for goods, for unprocessed goods for intermediate demand. So for those of us in supply management, these are the kinds of ingredients or components or assemblies that we're buying that go into our final products that go into the end customer. So they're a very good indication of what's happening with prices in the middle of the value chain, not for final consumption, which the PPI also measures at a different index. And you can see this data from last summer, but in July of last summer, we were standing at about 60% higher prices in aggregate for all overall. This includes, by the way, food and energy for all components for intermediate demand. And this is very important to understand. When we're dealing with a hot commodity, right, and a shortage in one commodity market, well, that's not an uncommon situation. And what we often strive to do is contain those costs and then look to offset those increased costs in other parts of the business. Maybe there's a commodity where I can offset because it's actually decreasing in price. Maybe I can do something on the labor side of my business. Maybe my SG&A, I can affect the total cost of my product through SG&A. But in the current environment, that's not really a strategic option. We're paying more for every single commodity that we buy. And I'm going to get into some of the detail around that. But in addition to that, we're also paying more for energy, paying higher costs for labor. We're paying higher costs for warehousing and much higher costs for transportation and logistics. In other words, there's no area of the business that's not impacted by higher costs. And we have no choice. I mean, I don't know very many businesses that have 60% operating margins on their product, right? It's a rare business that has something that high. When you've got 60% higher costs in your cost structure, you really have no choice but to pass costs on to your customer, whether that's that's the end customer or whether it's your buying company who's an intermediary customer ultimately. So that explains, I think, why beginning last summer we began to see inflation ramp up, and why, frankly, companies have been preparing their customers for price increases, and there hasn't been a lot of pushback. It's the first time in maybe 2 decades where we've had kind of broad-based acceptance. Yeah, we're in an inflationary spiral, and your cost adjustments make sense, and we're going to accept them. Now, maybe somebody disagrees with that scenario. Maybe in certain industries it isn't quite as easy to pass along those costs as it is in others. But broadly speaking, this has been an environment where companies are passing along price increases. Now, why is that? This is data from the Cleveland Fed. I want to point out how the recovery from the 2020 recession is so different in kind from all other recessions going back to 1959. So the average recovery is the blue line on the left-hand side of the chart. And this is the personal consumption expenditures for durable goods. So think of appliances, think of automobiles, think of furniture, things that we were buying a lot of those things, especially in the early days of the pandemic. You can see this was indexed to 100, and that typically in the period from the beginning of a recession all the way to 14 months out of the start of the recession, our expenditure on durable goods as consumers wavers a little bit, but doesn't really move a lot. It's pretty stable. But contrast that with the red line. Our expenditures on durable goods contracted extremely sharply from the start of the recession for those first 2 months. Again, it's March and April of 2020. And look what happened after we got through April. We were already back to where we were before the recession. And then it started to climb, and it steadily climbed for the ensuing 12 months. When we were at home, we were buying electronics so our kids could get schooling, right? We were buying electronics so we could work from home. We were building home offices. We were fixing up the backyard. We weren't going anywhere, so we wanted to fix the deck. We were cooking at home, so we were upgrading our kitchen appliances. We had an unprecedented demand for goods. This was a demand. So the first part of the recession was unusually, because we don't typically see this, it was a supply shock that caused the recession. We went into lockdown, we couldn't get supply. We moved through that very quickly, thanks to some very aggressive fiscal policy and monetary policy on the part of governments worldwide. You can see that in the second chart on the right-hand side here, real disposable income for households in the US spiked sharply and remained elevated for the entire period post-recession. So we had more cash to spend. We weren't spending on commuting. We weren't dining out, right? We weren't getting lunch at work. We weren't getting a haircut. We weren't going on vacation. We didn't have to buy as much gasoline. So we were saving more money. At the same time, the government was very aggressive with its fiscal stimulus policy. We were receiving stimulus checks. So we were building up savings. In fact, even today, US households are sitting on about $2 trillion more cash than they had before the pandemic. You have to understand that $2 trillion is equivalent to 10% of the entire US GDP. That's a lot of cash sitting in our household bank accounts right now. So that, as long as consumers continue to spend, and right now, in the face of higher inflation, the evidence is consumers are still spending at the higher price levels. They're not withholding their spending because of higher prices. Now that could change. And if it does change, that would be an indicator of the US moving into recession. But right now we're feeling pretty good, feeling pretty flush, and we've got a lot of cash. I want to share this other chart from the Cleveland Fed. This relates the level of spending on durable goods again in timing with the distribution of the 3 stimulus checks. You can see the first stimulus check came out in April of 20. So I've been talking consistently about March of 20 and April of 20. You can see that spending on durable goods was declining from the February levels. But when we got our first stimulus check, it jumped up. And it remained elevated right through the end of the year, after that first wave of stimulus. Then a second wave of stimulus hit. I think people were anticipating the second check a little bit. And so we saw the numbers ramp up in December of 20 in anticipation of getting those checks. And then they stayed elevated again after that second check came out. And the same thing happened with the third check, came out in late March or April of 2021. We anticipated the arrival of the check, we spent more, and then it stabilized at a higher level. This is a change in the demand curve for all of those goods that we bought, all those kitchen appliances or whatever else, bicycles, exercise equipment, all the things that we bought during the pandemic. And frankly, in our supply constrained environment, we cannot keep up with the level of demand that has been created by this government fiscal policy and by easy monetary policy on the part of the Fed. Now, you could argue, and I would argue, I think, with the benefit of hindsight, that we might have overdone it a little bit with stimulus, that we accelerated demand, increased demand artificially a little too much, and that's one of the reasons we're experiencing inflation in the economy right now. But I have heard Fed Chairman Jerome Powell, Jay Powell, say, listen, we were faced with an unprecedented event when the pandemic broke out. We had the outbreak. We had no idea if this was going to be a global depression. We had no idea what the impact on consumers and the business would be. So if I had to make a mistake and err on the side of overstimulating, that was where I was going to make my mistake. I was not going to err on the side of providing too little stimulus. And I think, you know what? I'm not going to fault him for that. I think we did create some demand, which is now leading to inflationary pressures in the economy. But I guess I'd rather have inflation than depression, right? So that's how I come down on that. So moving on to the next ISM data, I want to share with you some information about changes in lead times, which is again something we report every single month in the two reports, and the change, how lead times are related to price movements. Now, on the left-hand side of this chart, we've got data from 2008. You can see in that blue rectangle, we've got the manufacturer supplier deliveries index, and that blue line is dipping below the 50 level. When it dips below 50, in this case, it means supplier deliveries are accelerating. We're getting them faster than we normally do. When it goes above 50, it means supplier deliveries are being slowed down. We're getting them not as frequently or not as fast as we typically do. Now, this makes sense because you can see that the orange line is the price index, and what we're seeing here is supplier deliveries accelerate when prices decline because there's been a drop in aggregate demand in the economy. Now, if you compare that to immediately to the left, you can see the orange line, which is the supplier deliveries index, is very, very high in the period of 2007. You can see supplier deliveries slowing down because they're moving in a pretty pronounced way above 50 during that time period. What happens in that time period is we got an increase in aggregate demand in the economy. And when you have an overall level of aggregate demand increasing, in the short term, suppliers can't keep up with it. You know, first of all, they need to be convinced that it's real change, it's real demand, it's not just temporary. But production capacity can't expand as quickly as demand is expanding. And so you get higher prices and you get customers being put on allocation. That's what we're seeing right now, right? We've got demand outstripping our ability to supply it, getting higher prices, and we're getting customers put on allocation across the board. So this is a typical sort of movement. Changes in aggregate demand correlate, when they're going up, they correlate with longer lead times and higher prices. When it declines, it correlates with shorter lead times and lower prices. The reason prices fall is that, you know, the suppliers want to move their equipment. They're trying to preserve their sales. They don't want to be stuck with inventory. They're trying to incent their customers to buy. Now, you'll see in the spring of 2020, in the far right-hand side of this chart, we had a very different event. We didn't have the supplier lead times and prices moving in the same direction. They moved in opposite directions. That's because it wasn't a demand-driven recession. It was a supply-driven recession. Very unusual event. We don't typically think about it, but there's always supply and demand and equilibrium is always the cause of these changes. And you can see that prices were declining even as lead times were increasing. Lead times were increasing because we couldn't move anything from China, right? We couldn't, China had shut down, factories were not producing, ports were not open, we couldn't get supply. And yet prices were falling because people were trying to move product, we couldn't physically move it, couldn't get access to it. So very unusual scenario for a very brief period of time. And then you can see on the far right-hand side of the chart, as we accelerated demand in the economy through both the monetary and fiscal policies that I've already alluded to, you can see we restored the normal pattern. So lead times increasing very dramatically and prices very dramatically along with them. Now, this chart here is essentially the same data, but I show it to you because every month in the report, we report on commodities that are in short supply or up in price or both. And what is kind of unusual at this current time, you can look at that list on the far right-hand side, it's almost everything. It's everything from adhesives to steel, right, in alphabetical order. And you can see that those parentheses, those numbers in parentheses to the right-hand side indicate how many months that trend has been reported. So look at aluminum, has been up in price for 18 consecutive months. Diesel fuel up in price for 11 consecutive months. Electronic components up in price for 12 consecutive months. And by the way, semiconductors up in price for 10 consecutive months, but it's not just integrated circuits, it's not just semiconductors. It's basic electronic components like transistors and resistors and capacitors. So we've got a chronic shortage situation in the electronic components industry, and I'll have some comments on that in a second. See, ocean freight is up or in short supply for 8 months in a row. printed circuit board assemblies in short supply for 4 months. It's everything from corrugate and glass to fuel to polyethylenes and resins. It's everything that goes into everything else that we make in this country. And when it's that widespread, it reinforces the idea that we saw in the PPI data earlier, that we're paying much higher prices for every commodity that we need to run our businesses. So we've done some recent research with ISM members, not just in the United States, but actually this is global data. And there were some very interesting findings that with regard to pricing changes, do people agree or strongly agree that we have a workable plan to mitigate price increases? And you can see that a majority of people, somewhat agree or somewhat disagree that they have a workable plan to mitigate price increases. Only about 30% of people said we do have a workable plan. So there's not a lot of optimism that we've got the inflationary pressures under control at the moment. We've also asked them, are you conditioning your own customers to expect price increases? And you can see that a large majority, from somewhat agree to strongly agree, that's well over, what is that, 46 plus 30, it's 75%, isn't it? 75% of all companies have been conditioning their customers to some degree to expect higher price increases. So that's what when I mentioned that there isn't a lot of pushback right now. We're talking to our customers about to expect price increases, and our customers are often accepting them. We're able to pass some price increases on to our customers. A majority of firms, well over 70% of firms, say, yeah, we have been able to pass. We've had success in passing along those price increases. The volatility of commodity prices has decreased our profits. A large number of companies somewhat agree, or strongly agree with that. So again, that reinforces the idea of the widespread nature of these price increases. And we have no choice but to accept price increases from our critical suppliers. Again, 54% of companies agree or strongly agree with that. So inflation is a reality that we're dealing with at every step of the value chain. When we asked companies about their highest ranked concerns, the list of challenges is fairly what we would expect, and there's not a lot of improvement as we get back into the fourth quarter of 2022. So the first quarter, which we've just come out of now, versus the fourth quarter of this current year, hiring and retention, although that's moderating a little bit, is the number one concern for most people. Inflation is a number two concern. The strength of demand is a concern because we can't adequately keep up with the level of demand. And we can see that we expect these conditions to improve slightly by the time we get into the fourth quarter, but not dramatically. I mean, overheating of demand, we expect to see that improve pretty significantly. We expect employee retention to improve, but continue to be a challenge. COVID-19 continues to be something that we have a hard time understanding how the various variants are affecting our business. I think it's fairly obvious to most of us by now that China's no COVID policy. We've seen the shutdown of Shanghai most recently, and we've got Beijing on alert, for an outbreak in Beijing, the capital city. That no COVID policy has a rolling impact. Production in those certain areas gets shut down for a week or 2 weeks or more. Ports in those areas get shut down. That causes a backup in terms of commodities that we want to move across the ocean, across the Pacific to the United States. And then it releases all at one time, which makes the congestion problem worse when it arrives at West Coast ports of Long Beach and LA, for instance. So we get this bunching phenomenon that doesn't help us sort of smooth out the logistics snarls that we have. It continues to be an issue. When we asked people about their top concerns, you rank them from 1 to 10. And so if the lowest average score, which is 4.2 here, is the highest concern across the entire respondent group. And you can see that delays in shipment and supply is expected to be the number one concern continuing into 2022. And I've seen no data, by the way, that indicates that this is going to improve significantly in the remainder of this year. In fact, most CPOs I talk to expect this to continue through 2022 and into 2023. So we're learning to deal with it for sure. We're adapting to the new conditions, but people have never worked harder, And the bad news is we're expecting these tight market conditions to continue. Limited availability of raw materials and supply right after that, increased cost right after that, disruptions, right after that. Planning for risk mitigation and uncertainties is a high concern. And then the lowest level concerns are, lack of information from suppliers. That's good news, that there's good communication between buyers and suppliers. And a negative impact on organizational financial viability. I have some other data to share with you on this point in a second, but I mentioned the strength of the U.S. economy. We're still growing at 3%, which historically is a good number right now. So it's not that we're not able to grow, but we would be growing even faster if we didn't have these supply challenges, if we didn't have shortages of raw materials, if we didn't have a shortage of qualified labor, and didn't have these transportation issues. In fact, one of my favorite recent examples is from Apple. Apple, for the quarter that ended in December, announced record revenues, $123.4 billion in just the quarter. It's a staggering number. But Tim Cook also said it would have been $6 billion higher were it not for supply chain issues, specifically with the iPhone release for the holiday season. So even Apple, with its famous supply chain, was dealing with supply chain constraints. So it reported record profits and record revenues, but it would have been higher had it not been for the supply constraints. I'm seeing that play out in many different companies. We're growing, but we would be growing faster if we didn't have these supply challenges. So that's something to pay attention to. Now, what do we think about lead times? Well, lead times very early in the pandemic quickly went to twice their normal level. So if it's at 200%, that means it's twice as long as normal lead times would expect it to be. You can see that lead times out of China, for instance, are still at 216% of normal. They're still twice as long. And this is 2 years into the pandemic. We're still seeing these issues. On average, they haven't really improved a lot. We're almost twice as long out of Japan and Korea. Even in the United States, we're at 86% of normal lead time. So, that has, I think, to do with a lot of the other transportation issues. For instance, a chronic shortage of trucking in this country is extending lead times. Congestion on rail is extending lead times. And we know about the port congestion, of course, so that's extending lead times. So in general, we haven't really improved. The causes for lead times may be a little different today, maybe more transportation related than it was shutdown related, but we're still seeing shutdown related lead time issues. So it really hasn't improved, and it's a problem for many firms. So one natural reaction to these lengthening lead times is to do something about your inventory. A clear majority of firms are increasing their safety stocks. How are we dealing with potential disruption and potential volatility? We're going to hold more inventory to make sure we can keep our businesses running. 47% of firms say they're intentionally holding more than usual. By the way, I want to point out the second to the bottom data point here. 7% of firms are unintentionally holding more inventory than usual. And you see, that's not a demand issue. The backlogs have never been stronger. It's because we've got work in process inventory that we're not clear to build. We're missing a component. And so I can't ship to my customer. So that's actually not a good indicator, right? We're having problems. That's a further corroboration of my point that we would be growing even faster if we weren't dealing with these supply constraints. But a clear majority of firms are holding more inventory today. Now, I'm often asked, are we really moving from a just-in-time world to a just-in-case world? And my answer is no, I don't think so. I think this is temporary. When we get through the pandemic, I'm not going to say when we get back to normal, but when I say when conditions stabilize, I think the dynamic, the imperative around normalizing inventory levels is going to be too hard to ignore. And so we're going to get back to lean policies, just-in-time policies at some point. But right now, the near-term future is so unpredictable. The companies are protecting themselves by holding higher safety stock. And by the way, there's a very interesting study that has not yet been published out of Michigan State University that suggests if you're relying on your ERP systems to manage your safety stock, your buffer levels, those formulas that are built into the ERP systems are out of date and based on assumptions that aren't really applicable in our current environment. And so the authors of that paper suggest you go and look at the underlying formulas that that tell you what the safety stock levels should be, and they suggest that they're reporting safety stock levels that are inadequate to meet the current environment. So you might want to take a look at that, and it's worth looking into, I would say. Now, this is real data. I can't disclose the identity of the firm because I promised them confidentiality, but I was asking this is an industrial manufacturer. I was just talking to the global head of supply chain, and I said, can you give me some indication of what a pre-pandemic KPI looks like and a post-pandemic or current pandemic KPI, and how can we sort of quantify the impact on the business of these shortages? And he gave me two numbers. He said, so normally we're one of our key metrics is the customer delivery date, defined by when the customer requests that delivery. And we strive to meet the customer request date 95% of the time. Our normal range is between 92 and 94%. We do pretty good. If it gets below 92%, it's a major Kaizen event where we're trying to figure out what's going on, why are we unable to meet our customer request date. Currently, we're operating at 79%. It's and we're just not clear to build on a lot of our components. And this is a lagging indicator. We're not clear to build. We can't meet our customer requests because we've got issues in our own supply chain that are preventing us from operating at our normal levels. His leading indicator was what's his past due backlog for his inputs. Normally in his business, it runs about 0.5% of 1%, something that's past due from when they expect to receive it. It's not, currently 5 times worse than that at 2.7%, which to me doesn't seem that bad, but he pointed out it's 5 times worse than normal. Every quarter that persists equals a 3% decline in revenue. So on a compound basis, that's more than 12% revenue that we were foregoing. Now they're still growing, but we're talking about 12% of sales that would have been even higher on an annualized basis if they were clear to build in this one industrial manufacturer. So that's the kind of real world impact we're having with these supply constraints that we're dealing with right now in the economy. So prices are high. It's hard to get qualified workers. Lead times aren't good. Inflationary pressures are with us and look like they're going to be with us for some time. And our logistics situation isn't dramatically improving, although ocean freight is improving a little bit recently. So it's not a very good set of economic conditions if you're in supply chain today. So how are companies responding? Well, again, this is ISM data from earlier this year. The line I'd like to call your attention to is the China line, where 62% of the firms who responded to our survey said they had a major supply chain presence in China. I mean, that stands to reason, right? Most firms operate on a global basis today. Most firms either have significant sourcing from China or manufacturing in China themselves. To the right of there, you can see 17% of those same firms have planned a shift away from that reliance on China. Doesn't mean they're leaving China, but they're planning, rebalancing. And 13% of firms are already doing it. So 30% of firms with a major supply chain presence in China are saying we're de-emphasizing China as part of our risk strategy going forward. Doesn't mean they're leaving China. As I frequently tell people, General Motors sells more automobiles in China than it sells in the United States. It's not leaving China, right? But and China is too important. Some people, people often say that China is the world's second largest economy. Well, that's in absolute terms, but on a purchasing power parity basis, China is the largest economy in the world and has been for a number of years. No one's unplugging China from the global economy. But because of concerns about risk and volatility, and because of the reality of geopolitical tension in the U.S.-China relationship these days, companies are a little bit more skittish. You could, in broad brushstrokes, you could say the prior 30 years were about a consensus about the benefits of international trade. We replayed the general agreements on tariffs and trade with the World Trade Organization. China acceded to the WTO in 2001. The euro was launched in 1999. All these seminal events that led to conditions that were mostly about opening new markets and expanding our growth. And you could see the beginning of the 2000 or the 2010s, 2000 teens, that consensus beginning to fragment a little bit. We had the Brexit vote in 2016, which was a reaction on the part of British citizens on the number of other European country citizens holding jobs in the UK. They were not happy with that. That was a reaction. We had the Trump administration imposing tariffs in 2017, beginning in 2017, which, by the way, the Biden administration has not rescinded. Right. So there's been a dissatisfaction with some of the implications or outcomes of fully globally extended supply chain. During the early days of the pandemic, we became very aware of our dependency on China for things like personal protective equipment in hospitals. Most people didn't realize that 80% of active pharmaceutical ingredients in our medications in the United States are sourced from China. We have a critical dependency there. We have critical dependency on rare earth minerals, which we need in all of our electronic products. China has a de facto monopoly on rare earth minerals, not because they're not found in other places around the world. They're found in plenty of places. But a lot of countries don't want to mine for them, including here in the United States. So when we choose not to mine, we're also making a supply chain decision that has implications for both our national security and our economic security. So we were wondering about the so-called China plus one strategy, or de-emphasizing it. But this is the first data I've seen, this ISM data that says it's real. We are not leaving China, but we are de-emphasizing China. We're rebalancing global supply chains. Now, this is a little bit of a historical view. I love this Business Week cover from, I guess it was 1999. It was kind of scary, the China price. That was when we were full bore moving to China, especially if you were in manufacturing. The labor price arbitrage was so overwhelming. We didn't even care about the cost of moving the goods. It was just so much cheaper to manufacture in China. We just went there. And what's happening today? Well, global single source is definitely coming into question. In pharmaceutical, for instance, GlaxoSmithKline is very open about saying we're dual sourcing most of the things we're requiring in our supply business. Global plus one is definitely a reality. I'm going to be in China, but I'm going to stand up a supplier, or I'm going to ask my supplier to stand up a second location in another geography to mitigate both geopolitical risk, climate change and weather risk. In region for region, or local for local, or region for region is definitely a strategy that's being adopted. I'm seeing companies who used to source components from China, bring them back to the United States for final assembly, and then airship them back to their customers in Asia. Well, they're not doing that anymore. They're just sourcing from China to distribution centers where they can do final assembly in region and drop ship to customers directly. So there's definitely changes in strategy. The overwhelming logic of aggregating your spend volume, handing as much of that as you can to a single supplier to get total lowest cost of ownership, and lowering your cost structure that way, lowering your COGS, that is being questioned. I'm not saying that it is being reversed wholesale, but companies are definitely thinking about risk. One of the things that I talked to one CPO who said, yeah, we forgot that the risk was always implicitly part of the cost of our product, but we forgot to price it into our models. And you're seeing companies now literally price it into their models. I'll talk about market share in a moment. Companies whose supply chains performed well, particularly in consumer-facing industries, compared to their competitors who struggled with their supply chains, won market share. I know one consumer foods business whose overall sales are up 10% compared to pre-pandemic. And they did some analysis and they said, has consumer behavior really changed that much? Are we really generating 10% more business? And their analysis came to the conclusion that 5% of that is a change in consumer demand. Yeah, they are buying 5% more of our product because they're eating at home, they're cooking at home, and so forth. But the other 5% is our competitors had stockouts. And so consumers are buying our product because we had it on store shelves, and they didn't. It's happened to Kellogg's too. Kellogg's is very public about in their public filings that they won market share from their closest competitors because of their supply chain strategies. I was on a panel with a risk manager from McDonald's Corporation last week, And he said that McDonald's is, well, they're dealing with the same inflationary pressures that all the other fast food businesses are. They think they have strategies that will allow them to contain and mitigate price increases relative to their competitors. And you know how price sensitive that business is. So if my favorite chicken sandwich goes up by 50 cents per sandwich at one outlet, but McDonald's keeps my chicken sandwich price in line, that consumer is going to go to McDonald's to buy the chicken sandwich. And so companies are actively using their supply chains to try to take market share from their competitors. It's a new space for us. We used to be focused on cost. Now we're focused on growth and market share. And it's a real challenge. So, and a real opportunity. So one thing that's been happening for a while, ever since the tariffs were really announced, one country in particular seems to be benefiting from this rebalancing of global supply chains, and that's Mexico relative to China. You can see that the manufacturing labor costs in China are significantly higher. Mexico in 2020 was still below where China was in 2016. There's a very advanced manufacturing environment, aerospace, defense, and automotive in parts of northern Mexico. Northern Mexico doesn't have the same challenges in terms of moving product across borders and is not subject to the tariffs. So there are a lot of natural advantages for companies who are considering bringing their supply chains closer to their end customer to reduce risks of transportation issues, warehousing issues, avoiding tariffs, keeping labor costs under control. Mexico looks like an attractive alternative to a place like Mexico. Maybe Mexico becomes the +1 in a China +1 strategy. And there are many people who believe that we're seeing the regionalization of supply chains. What was basically one essentially globally extended supply chain from China to the rest of the world might, over a period of 5 or 10 or 15 years, become a set of regional supply chains, maybe Europe and Eastern Europe focused supply chain, a North American focused supply chain, LATAM supply chain, an EMEA supply chain, an Asia Pac supply chain. One of the benefits for companies who go to that approach is if I've got a problem in EMEA, it may not infect my supply chain in North America. My North American supply chain may operate just fine. And so there's a potential risk protection from there. I would argue that there's really been kind of a new paradigm. The old paradigm was characterized by these typical considerations. We're focused on cost, focused on assurance of supply. We're focused on rationalizing our supply base to get that lowest total cost. We had a supply focus, and we were operating in an environment of geopolitical consensus. I would argue today, the characteristics that we consider today, the factor to consider today, is free cash flow, right? What's our cash conversion cycle? Are we holding our customers, our fulfillment of our customers' orders back because we're short and we're losing out on sales? Speed and agility is arguably more important. Although I do hear CPOs make the case that assurance of supply is the #1 mission of supply management in today's environment. We've got to have our stuff more than cost. And I'm certainly hearing more than episodic evidence or anecdotal evidence that companies are still willing to pay a premium to assure supply, right? And to lock down capacity against their competitors. Whereas we were focused on a rationalized supply base in the past, we're really focused on disruption risk today. That supply focus, who's my best supplier, is based on demand. I'm trying to keep up with demand. And we're operating in an era of geopolitical conflict and the uncertainty that comes with that. So the factors that inform our strategies are radically different today than they were just 2 years ago. I think that I don't think people would disagree with that. But I think it's important for us to understand and focus on that and evaluate our supply strategies in the current context, which I believe is not going to change dramatically in the next couple of years. So some examples of some of these new strategies. I mentioned GSK earlier. They're focused on dual sourcing now. These are all publicly, examples in the public domain, so that's why I can use them. Schneider Electric is a global electronics manufacturer and distributor. Dan Bartel and I were in a meeting a couple of weeks ago in San Diego, very open about their regionalization strategy. They're standing up 3 manufacturing facilities in the United States that didn't exist, prior to 2022, to help them focus on in-region, for-region supply chain here in North America. And I mentioned the Kellogg's example. They're winning market share because their supply chain is performing, whereas the competitors are not. So there's some new points of emphasis, some new willingness to consider higher cost as a trade-off to risk, because what a CEO and a board can't stand is I'm having supply chain issues and I'm losing market share, because that could be permanent loss of market share. That could be a permanent erosion of my competitive positioning. That is a CEO level topic. It's a board level topic. And we right now are the organization that is being looked to assure that we're maintaining our firm's competitive position. And that's it. So I'm going to pause there. Looks like we've got a few questions. It's great. Ideal timing. I've got about 10 minutes left. So Preeti, I'm going to turn it over to you and let you fire away at me.
Yeah. Thank you, Tom. Great insight. We don't have any questions yet for the audience, but maybe I can start off, right? I'm not an economist. A lot of data that you presented, obviously, is really helpful in especially in our profession as a procurement professionals, right? And I think maybe I can ask questions related based off of that. Looks like companies should consult their economist on a regular basis, but they don't have one. Should they get one? That's another thing. A lot of companies don't have, I guess, expertise built in where they're actually utilizing the data that you presented today as a factual basis for shaping their deals, negotiations, any such thing. So
I would argue that use the PMI data that's published for free as a starting point. I know one CPO, when he was at Danaher, when Larry Culp was still running Danaher before he was running GE, he would summarize the ISM data every month, send it out to the executive committee of Danaher. And Larry Culp once commented to him, he said, I'm the CEO of a big public company. If I want Goldman Sachs to come in here and present to me on the US economy or the global economy, they'll be here in 20 minutes and they'll do it for me at no cost. But he said, this is the best economic insight I get every single month. It's from ISM. Yeah. So I would encourage you to understand, and I'll give you a couple of quick examples. One of the things we cover in the reports is, it just coincidentally, there are 18 sectors of the manufacturing economy and there are 18 sectors of the services economy. It just happens to be the same number. But we report on all 18 and which ones are growing and growing faster and which ones are contracting. So if you're a B2B company and there are certain sectors of the economy that are really important to you, you can tell whether your customer's industry base is doing better or doing worse. Your sales team might want to be interested in that data, right?
Yeah. Yeah.
So what's happening in commodity markets? We don't give you granular pricing detail. We give you pricing trends, and we give you trends on how many months. If you see that for 2 or 3 months and it's an important commodity for you, you've got to be coming up with a new strategy, right?
Yeah. No, thank you. I think it's important. I think we undermine the data that's at hand and available to us. That is certainly really factored in on, for a lot of decision-making comparisons and anything that the business might be interested in. I think today was probably the first time in a long time that we've actually had some insights into how this data is generated. And so thank you for that. Thank you for that. Sorry, just quick thing here. I have one of our viewers are saying great presentations that offer deep insights. I missed the last slide, so please briefly return to it. So if you can go back to the
this one here.
Let's just see if that's the slide. Eileen, if you're still on, can you confirm? Yes, thank you.
Okay. That's good. And I know that this is being recorded, so you get in touch with Kathy Perna after the fact if you want to get these slides are available for anybody who wants to use them. So
yeah.
And if anyone has got any questions and wants to go into a little more detail, just send me an email. I'd be happy to do that.
If I can fire away one more question for you on my side, because I still haven't seen much come through, but what are some other indicators should the companies or professionals keep an eye for the next 2 years? I mean, what do you think is, I mean, we don't have a crystal ball, I understand that, but we still need to think about what else can come through which has not disrupted just yet enough our economy globally.
Yeah, I think I'm not as optimistic about inflation as some people.
Hmm.
So I would pay attention to that. One of the things I'm seeing right now that some companies that we talk to tell us is that they've had to pay higher wages, and those higher costs are now, we haven't seen that yet, but inflationary pressure to date has been based on the cost of components, ingredients, and so forth. But now we're seeing it move into the wages side of the economy. And as economists will tell you, if that becomes, if people are starting to win real changes in their compensation to keep up with inflation, that in itself can lead to the conditions of inflation. So I would be talking to my suppliers about, what are their plans? Because there's one school of thought that says prices, they're going to move higher and then they're going to stabilize at the new price level. We'll have equilibrium between supply and demand again, and it'll just be at a higher price. But that means that a year-over-year basis, we won't be seeing inflation.
Yeah.
I'm not sure. I think we have some waves of inflation yet to go. The other opportunity, as the commodity markets begin to maybe come back to normal a little bit, pay attention to when commodity prices begin to drop and go back to your suppliers and say, okay, we agreed to the price increase because aluminum was up, but aluminum is down now. Where are my concessions? I agreed to your logic on the front end. You need to agree to my logic on the back end. And we need, to be equitable in the relationship. So definitely look for movements there. The ISM data can help, but there are lots of good sources on commodity market data.
Great. Thank you so much. Let me just make sure. Okay, logistics related to importing from China, as you point out, created disruptions. Given the COVID situation in China, is it natural to assume shipping durations will remain a major risk?
Yeah, I think so. And for a couple of reasons. We're still, by the way, we're importing into Long Beach and LA somewhere between 14 and 19% more product today than we were before the pandemic. That's that surge in the demand for goods. So even if everything was operating perfectly, we'd still be struggling to keep up. But we're going to continue to have these bunches. I don't know that there's any indication that China is going to reconsider its no COVID policy, but their vaccination rates in that country are much lower than they are in the United States, for instance. And so as long as that's the case, they're going to be having more outbreaks, and it's going to cause these unpredictable short-term kind of shutdowns in the various ports. And that's going to, it could be one of your China-based suppliers this month, and it could be an entirely different supplier shipping out of a different port the next month, and it's going to be impossible to know. That's going to be a continuing game of whack-a-mole there.
And I think just in the interest of time, one more question for you. What trends are occurring in organizations to be better equipped based on lessons learned and headwinds in terms of infrastructure, for example, org restructuring, human capital, skill, talent, etc.?
Yeah, very good question. And there are clear changes in this area. I'll try to be very brief. There's this other trend that's going on, which is around ESG and sustainability. And it's accelerating some of the factors that came into play because of the pandemic. So one thing that's happening is that companies are trying to gain more end-to-end visibility in the supply chain. So in the electronics industry, it's not just, is my supplier getting me my components, but where are they getting their raw materials? At which mine? And what are the labor conditions at that mine? And how much carbon dioxide is emitted during operations of that mine? Because all of that is going to be reported in sustainability and ESG reports. It also gives you more predictability. So extending your end-to-end visibility allows you in some cases to build a direct relationship with your supplier's supplier. And I'm seeing that happen more often. Not just relying on your tier ones or maybe your tier twos, but going to tier 3 or tier 4, because they're critical. they're a nexus supplier for me. And if they have a problem, I need to know about it, and I want to be assured of supply. In terms of overall strategy, one thing that's very noticeable about this time compared to 2008, 2009, you remember in that era, we were all extending our payment terms to our suppliers, pushing them out 45, 60, 90 days. That's not happening right now. In fact, people are pulling in payment terms for a critical supplier who might be having a liquidity problem, right? Or they're buying raw materials on consignment on behalf of that supplier, or they're arranging supply chain financing for that supplier. So very different psychology. And that's because I think we realize we don't have our supply ecosystem. We're not in business.
That's right.
And so it's a different mindset, and it's a healthy mindset. And people are therefore focused on supplier relationship management, having strategic conversations with their supplier. One of the yes, technology is going to help us become more efficient in our field, no doubt about it. Whether it's source to contract software, all of that stuff is helping us. But we've done some analysis at ISM that says of the 32 basic source to contracting tasks, all but 9 of them are going to be automated within 10 years anyway.
That's right.
The critical ones all depend on us as people. And that is, sharing our long-term growth strategies to the supplier, understanding their technology roadmap and sharing our technology roadmap as an example, so that we can grow and win together. And I think that's that realization that we have to, in the old days, it was about information asymmetry and like keeping my cards close to my vest, right? And not sharing as much information.
Yeah.
That hasn't gone away completely, but there is more openness.
I think there's a lot of leverage, to your point, when you share knowledge. And I think from a technology front as well, I mean, take sustainability, a lot of programs that our suppliers are doing, we can actually leverage it within their investment of things and drive our commitments along with that, just as one area of example.
Yeah, and we're going to have to, in order to, because 80% of greenhouse gas emissions happen in the supply base.
That's right. Scope 3s are coming from our supplier side.
Yeah.
Absolutely. I'm mindful of time. I know folks are still hanging on. We have questions coming through, and I want to be mindful of your time as well. Did you want to take more questions, or at this point send them over?
I can take a few more questions. Sure, why not?
Okay, I have 2 more, and then maybe we'll at that point, folks. How will the war in Ukraine going to impact the semiconductor industry and the shipment of computer chips?
Yeah, one of the critical items that is sourced from that region, in Ukraine in particular, both xenon and freon are gases that are required for semiconductor manufacturing, and Ukraine was a major provider of those gases. Now they are a byproduct of other industrial processes like steelmaking, for instance. So we will be able to find alternative sources of supply. And I think many people anticipating in that industry, anticipating the war, were buying ahead and getting. So semiconductors seem to be in pretty good shape from that point of view. There are other major impacts, right? 25 to 30% of the world's wheat comes from that region. In food, 80% of sunflower oil, which is a very commonly used ingredient in food manufacturing, came from Ukraine. So that's a big deal in that industry.
With that, Tom, I think we will send you any questions that are still coming through. But I want to thank you so much. Great insight, great data, really thought process of where we need to change our mindsets is happening now for the good. So again, thank you very much for being our guest speaker today. Really insightful, and you've enlightened, with your deep thoughts and data here today.
Thank you very much, Preeti. I really enjoyed it.
Thank you, everybody. Troy.